Chapter 2 outlines the development of a conceptual framework for financial accounting and reporting by the IASB. A conceptual framework is important as a coherent system of concepts that flow from an objective, and the objective identifies the purpose of financial reporting. By building upon an established body of concepts, a soundly developed conceptual framework leads to more useful and consistent pronouncements over time and allows the accounting profession to solve new and emerging practical problems more quickly. In 2018, the IASB published Conceptual Framework for Financial Reporting. The IASB worked diligently to complete the conceptual framework, as the board recognizes the need for such a document to serve its diverse users. Thus, the conceptual framework can provide guidance to many situations where an IFRS does not cover the issue under consideration. First level, basic objective. The objective of financial reporting is the foundation of the conceptual framework. The objective of general-purpose financial reporting is to provide financial information about the reporting entity that is useful to present and potential equity investors, lenders, and other creditors in making decisions about providing resources to the entity. An implicit assumption is that users need a reasonable knowledge of business and financial accounting matters to understand the information contained in financial statements. This means that financial statement preparers assume a level of competence on the part of users, which impacts the way and the extent to which companies report information. Second level, fundamental concepts. The second level bridges the why, or objective of accounting, with the how of accounting that addresses recognition, measurement, and financial presentation. The fundamental qualities that make accounting information useful for decision-making are relevance and faithful representation. Firstly, A. Relevance. Accounting information is relevant if it is capable of making a difference in a decision. Financial information is capable of making a difference when it has predictive value, confirmatory value, or both. If the monetary size of an item could influence a user's discussion, then the item is material and must be disclosed. 1. Predictive value. Financial information has value as an input to predictive processes used by potential investors in forming their expectations of a company's future. 2. Confirmatory value. Financial information that helps users confirm or correct prior expectations. 3. Materiality. Materiality is a company-specific aspect of relevance. Information is material if omitting or misstating would make a difference in users' decisions. It requires evaluating both the relative size and importance of an item. While companies and auditors adopt a general rule of thumb is that anything under 5% of net income is considered immaterial, this depends upon specific rules. Companies must consider both quantitative and qualitative factors when determining materiality thresholds. Then we consider B. Faithful representation. This means that the numbers and descriptions contained in the financial statements match what really existed or happened. To be a faithful representation, information must be complete, neutral, and free from error. 1. Completeness. The financial statements include all the information that is necessary for faithful representation of the economic phenomena that it purports to represent. 2. Neutrality. Information is neutral if it is unbiased, i.e., it is not presented in a manner that favors one set of interested parties over another. And 3. Free from error. Does not mean total freedom from error. It means that the information presented is as accurate as possible, given that any estimates are based on the best information available at the time. The enhancing qualities are complementary to the fundamental qualitative characteristics. They include comparability, verifiability, timeliness, and understandability. A. Comparability. Information that is measured and reported similarly for different companies is considered comparable. It enables users to identify the real similarities and differences in economic events between companies. Another type of comparability is consistency, which is present when a company applies the same accounting treatment to similar events, from period to period. B. Verifiability. This means that different knowledgeable and independent observers could reach a consensus that a particular depiction is a faithful representation. C. Timeliness. This means having information available to decision makers before it loses its capacity to influence decisions. D. Understandability. This is the quality of information that lets reasonably informed users see the connection between their decisions and the information contained in the financial statements. Understandability is enhanced when information is classified, characterized, and presented clearly and concisely. The following 5 basic assumptions underlie the financial accounting structure. A. Economic entity assumption. This means that economic activity can be identified with a particular unit of accountability. In other words, a company keeps its activity separate and distinct from its owners and any other business unit. B. Going concern assumption. In the absence of information to the contrary, a company is assumed to have a long life. The legitimacy of the cost principle is dependent upon the going concern assumption, whereby depreciation and amortization policies are justified and appropriate only if there is some permanence to the company's continuance. C. Monetary unit assumption. Money is the common denominator of economic activity and provides an appropriate basis for accounting measurement and analysis. The monetary unit is assumed to remain relatively stable over the years in terms of purchasing power. Therefore, this assumption disregards any inflation or deflation in the economy in which the company operates. D. Periodicity assumption. The life of a company can be divided into artificial time periods for the purpose of providing periodic reports on the economic activities of the company. And finally, E. Accrual basis of accounting. Transactions that change a company's financial statements are recorded in the periods in which the events occur. Next, we look at the basic principles of accounting that are used to record and report transactions. The 4 basic principles of accounting are: A. Measurement principles. We currently have 2 acceptable measurement principles: historical cost and current value. Choosing which principle to follow generally reflects the trade-off between relevance and faithful representation. 1. Historical cost. IFRS requires many assets and liabilities to be reported at their acquisition price, or cost, sometimes referred to as historical cost. Using cost has an important advantage. It is thought to be a faithful representation of the amount paid for a given item. Many users favor historical cost because it provides a verifiable benchmark for measuring historical trends. 2. Current value. This measure provides monetary information using information updated to reflect conditions at the measurement date. Current value bases include fair value, the value in use for assets, and fulfillment value for liabilities and current cost. B. Revenue recognition principle. When a company agrees to perform a service or sell a product, it has a performance obligation. Therefore, revenue is recognized in the period in which the performance obligation is satisfied. C. Expense recognition principle. Recognition of expenses is related to the consumption of assets or incurring of liabilities. And finally, the D. Full disclosure principle. Financial statements should include sufficient information to permit a knowledgeable user to make an informed decision about the financial condition of the company in question. Users can find financial information: 1. Within the main body of the financial statements, 2. In the notes to those statements, or 3. As supplementary information.